Does this look like a high probability DR upside model to you? At first glance it might, but looks can be deceiving. In this episode I break down last week's trades, uncovering key insights into IDR Basics and what separates high probability setups from low quality conditions. Let's go! Number 1. Gold Futures, Wednesday's price action, identifying a low probability DR upside model. Both the aftermarket and overnight DR sessions formed green DR boxes, confirmed longs, and continued higher while keeping the aftermarket DR session lows intact. This was a strong indication that a DR upside model was still intact and could potentially continue into the next session. With the regular DR session also closing bullish, followed by a long confirmation, and the overnight DR lows still holding, the DR upside model was technically still in play. However, this is where caution was needed when anticipating further upside. Targeting the +1 standard deviation level for a DR upside expansion model completion, where each session takes out the previous session's highs, was a valid approach. But looking at the broader picture, a key issue stood out. All three defining ranges were clustered within a price range, creating a consolidative structure rather than a clean expansion. This wasn't the textbook DR upside model formation you'd ideally want to see. Paying closer attention to the aftermarket and overnight DR mid-levels, extending them to the right, revealed that the regular DR session had violated both, moving back and forth between them rather than deviating upward in a true DR upside expansion model. This was a major red flag for expecting upside price action. Even though valid entries were available, such as at the IDR high and the opening price failed to make a new high and take out the overnight DR highs, further confirming the weak structure of this setup. This was the kind of weak DR upside model that could have easily turned into a false DR session. These sideways moving conditions lacked the clean DR characteristics necessary for high probability setups. Avoid these types of consolidative structures where price is moving indecisively rather than expanding in a structured manner. Number 2. S&P 500 Futures, Wednesday's overnight DR session. Gap imbalance from the ADR increasing probabilities in the overnight DR session. The aftermarket DR session started the DR-IDR intraday cycle, closing as a green DR box confirming longs and retracing back to its closing price and IDR mid before making a slight move higher. As the overnight DR session opened, price continued its movement from the ADR mid and an intraday gap imbalance that had formed within the first hour of the aftermarket defining range. Take note here, aftermarket gap imbalances are highly significant, as I've emphasized many times before. With the overnight DR session closing as a green DR box and confirming longs almost immediately, we not only have a DR upside model intact, but also a crucial observation. With this long confirmation, the probability is now around 80% that price will close inside the defining range or aim for higher standard deviation levels by the session's end, while there's only a 20% probability of price closing below the defining range. This lower probability is further reinforced by the presence of the aftermarket defining range intraday gap imbalance, which sits exactly at that level, acting as a strong barrier for price. In terms of previous DR session levels, nothing significant aligns with the current defining range, but we do have an open magnetic intraday gap imbalance inside the range, located in the retirement setup area alongside previous volume imbalances. Now that everything is set up, we patiently wait for a retracement to present a high probability trade opportunity. As price retraces back into the defining range, a potential trade emerges, but only if you have access to historical data to validate retracement probabilities. After making a new high and failing to reach the 1 standard deviation level, another potential entry presents itself, assuming that the maximum retracement for the session had already occurred. A bit of an advanced trade, but several confluences aligned, and even if this setup had failed, another entry deeper into the range would likely have offered an even better risk-to-reward opportunity. As price reaches the target, the regular DR session continues the DR upside expansion model, offering another long setup at the defining range highs. However, this setup would have resulted in a loss, reminding us that even in ideal DR upside model conditions, nothing is guaranteed. Number 3, Nasdaq 100 Futures, Wednesday's overnight DR session comparing with the price action on ES from Wednesday. While ES was a bit tricky to trade on Wednesday, Nasdaq presented a similar price action structure, but with a much clearer decision-making process. Here's why. During the aftermarket DR session, Nasdaq already provided a solid trade opportunity, rejecting the closing price and offering a clean setup with stops placed just below the defining range's mid. Just like on ES, the overnight DR session formed in a DR upside model with a green DR box. But here's the key difference. There was no confirmation in the first hour after the defining range had formed. Instead, price wicked above the DR high but failed to close above it on a 5-minute time frame. 2 hours later, the confirmation finally arrived. With a long confirmation now in place, a green DR box and a DR upside model formation, the probabilities were on our side, making longs the preferred direction for the session. In terms of volume and gap imbalances, we had multiple whips, including a magnetic one located inside the retirement setup area, something to keep in mind when planning execution. Now here's where this setup differed significantly from ES on the same day. On ES, there were no previous DR session levels close enough to add confluence, while on Nasdaq there was a previous DR session level from earlier week's price action that had just been broken for the first time since it formed. A crucial reference point that we definitely wanted to highlight. Looking closer at the current session, price retraced into this exact previous DR session level, confirming its relevance. Slightly below the candle, there was also a small open magnetic volume imbalance, providing an additional confluence for a potential rejection from this area. With the candle body closing above the previous DR session level, this was a clear entry signal. Placing the stop loss below the session's mid also ensured coverage of the previous DR session level, and with the target at the +1 standard deviation level, this trade setup gave a clean 3R opportunity. Price hit the target before continuing even higher, confirming a DR upside expansion model, making it another beautifully executed DR basic trade. Number 4, US dollar versus the Japanese yen, Friday's overnight DR session, DR upside model broken, turning into range expansion. The aftermarket and overnight DR sessions initially formed a possible DR upside model, with the overnight DR closing above the aftermarket DR while respecting its lows. However, the red DR box and an early short confirmation drastically decreased the probability of a DR upside model continuation, leaving only about a 20% chance that price would close above the defining range by the end of the session. With that being said, conditions weren't optimal and caution was required. A short trade in this scenario would be against the potential DR upside model, instead anticipating a DR range expansion model, where price takes out the aftermarket DR lows. Since the aftermarket DR highs had already been touched, target selection had to be precise. The lower the target, the lower the probability of success, given that the DR upside model was technically still intact. Reasonable targets included the +1 standard deviation level, which aligned with the aftermarket DR mid, and the 1.5 standard deviation level, positioned slightly above the aftermarket DR lows. Additionally, 2 previous DR session levels lined up with the current defining range, offering extra confluence for a short trade area. With everything set up, it was time to wait for a retracement back into the DR. As price retraced, it rejected the previous DR session levels 3 times and the IDR mid twice, confirming a high probability short entry. A stop at the -0.7 retracement level ensured protection, while also allowing for another potential entry in the retirement setup area if needed. Even with expectations not set too high, this setup provided a clean 3R trade while avoiding extremely low targets. Later in the day, as the DR upside model officially broke, price transitioned into a DR range expansion model to the downside, with previous DR levels holding major significance. Absolutely beautiful price action across all 3 DR sessions, and if you watched the last episode of Top 7 Trades, you would have anticipated this shift early on. And lastly, number 5, gold futures, Friday's overnight DR session, DR upside expansion model continuation in the ODR. A super simple, easy and basic DR trade presented itself in this session. The aftermarket and overnight DR sessions both pointed toward a potential DR upside model, with both sessions closing as green DR boxes, confirming longs, and respecting the previous DR session low. With probabilities already stacked in favor of further upside, the focus was on long setups and targeting new standard deviation levels, with a low probability that price would close below the defining range before the session's end. In terms of previous DR session levels, there weren't any relatively close to the current range, but there were several previous volume imbalances aligning with the range, along with an intraday gap imbalance. These were crucial areas to highlight and keep easily accessible for toggling on and off as needed. For potential long setups, targets could already be predefined. The +1 standard deviation level was a perfect confluence area, aligning not only with the next standard deviation level, but also with the aftermarket DR session highs, which should ideally be taken out in a DR upside expansion model. As price retraced into the defining range, it pushed straight through important levels, violating the DR high, opening price, closing price, and the range mid, before reaching the lower end of the defining range, setting up an ideal retirement setup. Several candles provided enough time and opportunity to take action before price extended higher, reaching even higher standard deviation levels. Later, the DR upside model broke in the regular DR session, and price eventually dropped below the aftermarket DR session the following day. A great example of a clean DR trade setup that followed the basic DR principles before the larger structure shifted. As always, don't forget to like and subscribe for more videos, and I hope to see you in the next one.
We're gonna take on the world.